If you're looking to invest in Vanguard Index Funds, this is the only video you'll need to watch. We'll be covering what are the best Vanguard Index Funds, how to buy them, how to open a Vanguard account, investing in index funds through a Roth IRA, and more. So be sure to stick around and feel free to use the table of contents in the description below. Vanguard has been around since 1975, and since then, over 50 million people have used their platform or investment products to grow their wealth. They're known for having some of the lowest fees in the investment industry, and this has led to Vanguard having a total of $7.2 trillion in assets under management. So if you're considering investing with them, you're in good company. We're going to dive into specific Vanguard index funds shortly, but first, let's cover why people invest in index funds in the first place. A lot of people think the stock market is risky, but that's only partially correct. Yes, buying individual stocks can be extremely risky. Just take a look at Supermicro's stock, for example. From the high in March, this stock is down about 68%. Yikes. However, buying individual stocks is not a recommended strategy, and that's because most people are going to lose money doing this. Instead, it's recommended to invest in a basket of different companies in a diversified manner. Warren Buffett, the greatest stock picker of our time, even proved this himself with his now famous bet against 5 hedge funds. He believed that a simple S&P 500 index fund would outperform all of them over a 10-year period. And during that decade, the S&P 500 ended up returning 125.8%. Meanwhile, the portfolio of hedge funds had returns generated from 2.8% on the low end to 87.7% on the high end. So that's why people invest in index funds. It's extremely difficult to beat the market, even for the professional stock pickers. Now, before we dive into the specific Vanguard index funds that most people invest in, it's important to understand the difference between the two types that are offered. Also, guys, if you've gotten any value out of this video so far, please be sure to drop a like as well as subscribe and hit the bell for the YouTube algorithm. Vanguard offers both ETFs, which are exchange-traded funds, as well as index mutual funds. Simply put, these ETFs can be purchased through any brokerage platform. Meanwhile, the index mutual funds must be purchased through the Vanguard brokerage platform. If we take VOO, the Vanguard S&P 500 ETF, for example, this can be purchased through any brokerage platform. However, the counterpart to this is called the Vanguard 500 Index Fund Admiral shares, and this is the index mutual fund that is exclusive to the Vanguard investment platform. Aside from that, another key difference is the minimum investment. For the index mutual funds, it's often a $3,000 minimum, whereas the minimum for the ETF investment is as little as $1. In addition, the expense ratio, or the fee paid to the investment managers, is actually slightly lower for the ETFs. In the case of VOO, that comes in at 0.03%, whereas the index mutual fund version is a 0.04%. The last key difference between the two is the trading window. For the ETF, you can trade this anytime the market is open, and with Robinhood, the platform I'm going to show you later, they actually offer this in what's called the 24-hour market, so you can trade this around the clock. For the index mutual funds, there's going to be one trading window per day, which is usually after the market has closed in the evening. Based on those reasons, most people prefer the ETF investment, as you have more flexibility, lower fees, and lower investment minimums, among other things. So we're going to be focusing on that as the preferred method for investing for the rest of the video. Now, we're going to dive into the most popular Vanguard ETFs, starting off with the most popular one, the Vanguard S&P 500 ETF. Also, guys, real quick, I am not a financial advisor. This is not any sort of financial advice, and you should always do your own research before investing. The Vanguard S&P 500 ETF replicates the performance as closely as possible of the S&P 500, which is the most popular index for tracking the US stock market. And the S&P 500 simply tracks the 500 largest publicly traded US companies, and the larger a company is in terms of their total market value or market cap, the more weight that they're going to carry in the index. So when you invest in the S&P 500 ETF, a large portion of your money goes right into stocks like Microsoft, Apple, Nvidia, Amazon, and Meta because of just how large these companies have become already. FinViz has a heat map that shows you a visual of this in action. The larger a square is, the more weight that it carries in the index. So when you invest in an index fund like the S&P 500, your money is spread out across all of those different different sectors and industries, giving you diversification across the entire US economy. So even if one particular company or segment of the economy takes a nosedive, the rest of what you own will help you to offset that loss. Now, according to NerdWallet, the S&P 500 has returned about 10% on average per year over the last century, assuming that you are reinvesting your dividends. Now I'm going to show you a simple strategy for becoming a millionaire with the Vanguard S&P 500 ETF. What we're taking a look at here is a compound interest calculator, and this shows you how the value of your money can grow over time through investment. We're going to be looking at an example here of investing $500 per month into VOO, and assuming that you have $0 to get started with, as most people are getting started from the $0 line. We're going to be looking at that estimated average return here of 10% using the NerdWallet figure, and the first thing I want to look at here is a 10-year time horizon. So if you followed this strategy of investing $500 a month over 10 years, if we click on the calculate button, this shows that your portfolio would grow in value to just under $100,000. Now looking at the chart here, the blue line shows your contributions or how much money that you put in, and the red line shows you the value of your portfolio from the growth of your money. So in this case, you invested about $60,000 and you've made about $35,000 from the stock market. So nothing too crazy, but you have had some decent returns here generated. However, the longer amount of time that you give your money to grow here, the more it is going to compound and grow at a faster and faster rate. Now, if we push out to the 20-year mark, most people would expect this to be roughly double, or about 200,000. But this is where you can begin to see the magic of compound interest starting to take place. At the 20-year mark, if we click here on calculate, you can see here that your portfolio would actually be worth about $343,000, which is quite a bit more than $200,000, or roughly double what we were at previously. Taking a look here again at the contributions versus the total value, at this point in time, you've invested about $120,000 and your portfolio is worth $340,000. So you've made about $220,000 in investment gains from the market. So at this point in time, you would have made substantially more from your investments than the amount that you contributed. Now, if you wanted to have a $1 million account, which of course all of us would, you would have to invest for just another 11 years. At the 31-year mark, you would officially have a $1 million portfolio with a total value here of $1.091 million. In terms of your contributions, you've contributed $186,000 and you've made over $900,000 in investment gains from the stock market. And if you take a look here at how that red line is just accelerating at a faster and faster rate, that is the compounding effect here that takes place. And the longer you allow your money to grow, the faster it is going to increase in value. So that is the long-term potential here of a index fund investing strategy. It can be boring at first, just like you saw, but keep in mind you have to be in the game for the long run in order to see these significant returns here that start off after about the 10-year mark. That is when things get really exciting with index fund investing. And if we take a look at this page here, this is going to give us more information about VOO, or the Vanguard S&P 500 ETF, which is going to replicate the S&P 500, which is what I just showed you in that previous example. So this is a very popular method for those who are looking to follow that exact strategy that I just showed you. The expense ratio comes in at 0.03%, and the dividend yield over the last 30 days is 1.23%. If we scroll down, we can get more information here. For example, it mentions here that this index represents the 500 largest publicly traded US companies, and it is considered to be a gauge of the overall US stock returns, as the S&P 500 is the most popular benchmark. In terms of the risk-reward scale, this comes in at a 4 out of 5, so it is going to be a bit more risky than some other investments out there, and that's because you have 100% allocation into equities or stocks. That's going to carry more risk than bonds, for example, which are going to have less downside potential, but also less upside potential. Further down, we can get more information about the performance over time as well as the fees, and you can see here how the returns have compared to the benchmark here of the S&P 500. So for example, over the last year, VOO has returned 36.32%. Meanwhile, the benchmark or the S&P 500 has returned 36.35%. So there's a very slight difference there, but for the most part, it is replicating the performance of the S&P 500 as closely as possible. Taking a look at the details over here, it mentions, for example, the total amount invested in this fund as of the end of August is 1.2 trillion, which is wild, just how much money is parked right here in VOO. And over here on the right, this style box is also helpful for understanding what you're actually investing in. At the top, it's going to show you whether you are making a value investment or growth here, which is where companies are trading more so based on their future earnings potential and growing at a faster rate than the average of the market. This is going to be a blended strategy, so it fits right here in the middle, meaning that you have a mix of both value investments and growth investments in this ETF, and it also shows you the size of the companies you're investing in. So in this case, since you're investing in just the top 500, it's mostly going to be large cap or large size companies that you are investing in. If we take a look at this pie chart here, this is going to show you what percentage of your money goes into different sectors. For example, here, if we look at what's going to be the largest component, that's going to be information technologies, making up 31.1%. The next largest category here is going to be financials at 13.2%, followed by healthcare at 12.2%, and so forth. And based on whatever companies are the most valuable in today's economy, that is going to change these allocations in terms of what percentage of your money goes into these particular segments of the US economy. And if you're curious about the largest holdings in that, down here, this is going to show you what individual stocks make up the largest portion of the fund. In this case, about 7% or 6.97% of the entire fund goes right into Apple stock. Then you have Microsoft making up 6.5%, Nvidia at 6.2%, and then you also have Amazon, Meta, the parent company of Google, Berkshire Hathaway, Eli Lilly, and Broadcom making up a large portion of the entire portfolio. So when you invest in VOO or the S&P 500 through other providers, a large portion of your money goes right into these stocks. And if we take a look here at the top 3 holdings alone, almost 19% of your money goes right into Apple, Microsoft, and Nvidia alone. Further down, we can get details here about the distributions or dividends, as many of the companies held within that portfolio pay dividends. So what happens is all of those dividends are collectively held onto and then paid out on a quarterly basis. So in this case here, it is a quarterly dividend payment, and you can get details here about the previous dividends and then future upcoming dividend payments from the fund. And of course, if you want to maximize your return potential, you'll want to reinvest those dividends back into the ETF, allowing you to own more shares and earn more dividends in the future. You can also down below get more information about the fund managers who are actually picking and choosing the investments, which are, as we said, replicating the S&P 500 as closely as possible. This is going to be a passive style of management, so there is a lot less human involvement, but this is where that 0.03% expense ratio goes towards, is paying these fund managers to allocate the portfolio accordingly. Up next on our list here, we have VTI, which is the Vanguard Total Stock Market ETF. This ETF tracks the performance of the CRSP US Total Stock Market Index, and this index represents 100% of the US investable equities market, meaning that you own a little piece of every single publicly traded stock in the United States through this fund. Now, just like VOO, this is going to be a market value weighted index, and that means that a larger company is going to carry more weight. So you're still going to see most of your money concentrated into the top holdings, but this is going to own a lot more individual company stocks. For example, with VOO, you own about 500, and with this particular investment, this is going to give you exposure to over 3,500 different companies, so you have more exposure to medium and small sized stocks or companies through something like VTI. As far as the expense ratio goes, this comes in at the same figure as VOO at 0.03%. 1.8%, and the dividend yield over the last 30 days is 1.22%. You can also get more details here about the benchmark as well as the performance over different periods of time. So year to date, for example, the return here has been 20.32%. If we look here at the portfolio composition, we can see that the number of stocks held within the fund is 3,656, which is quite a bit more than the 500 that you will see in VOO. However, there is quite a bit of overlap here between these funds because they are both market value weighted. In terms of the total assets held, this fund has an astounding 1.7 trillion in total invested capital. As far as the style box goes, this is in the same category here of VOO, being a blend of value and growth and heavy concentration into large-sized companies. So this will have a similar amount of risk to VOO, but it is slightly more aggressive because of the fact that you're getting exposure to the entire US stock market and picking up more of those medium and small-sized companies as a result. And smaller companies are going to be inherently more risky than larger, more well-established companies. Just like before, we can take a look at the sectors in terms of the overall exposure. This is going to be very similar to what we saw with VOO, and we can also look here at the top holdings. So for example, in this case, 6.14% of your money goes into Apple stock, whereas for example with VOO, we know that was closer to about 7%. So even though it is still pretty top heavy here in the big names and big tech here, looking at Apple, Microsoft, Nvidia, etc., you have slightly less of your money going into all of these top holdings because of the fact that you're picking up those bottom 3,000 or so stocks that are just not being allocated into VOO. Up next on our list, we have VEA, which is the Vanguard FTSE Developed Markets ETF. And this ETF tracks the performance of the FTSE Developed All Cap VXUS Index. This index represents about 3,700 small to large sized companies across 24 developed global markets, excluding the United States. So this ETF would be for those who are looking to diversify a portion of their portfolio outside of the US equities market and keeping their money in developed nations. We're going to be looking at emerging market funds as well in a little bit, but this is going to be strictly those that are already developed, not necessarily ones that are growing and still becoming established. Keep in mind, however, the US stock market has generated the greatest returns over the long run, so you wouldn't want to put all of your money or the majority of your money into an international fund like this. Instead, this would more so be used as a garnish to a well-rounded investment portfolio. If we take a look here at the details, the expense ratio comes in at 0.06%, so it's slightly more than VTI and VOO, but it's still quite a bit less than you would pay on average for fund investments out there. And just to show you here how the returns are lower, year to date, for example, the performance of this fund has been 10.82%, whereas with VTI, which we just looked at, it was north of 20%. So you will, in most cases, see greater returns being generated from the US equities market. In terms of the portfolio composition, this has 3,985 underlying holdings and a total invested in the fund here of $204.3 billion. So this is a very popular ETF that Vanguard offers. Taking a look here at the overall exposure, this shows us what regions make up the largest portion. So in this case, 54% of your money is invested in Europe, 35.5% is invested in the Pacific region. The next largest category here is North America, most likely Canada being picked up there. And then you have the Middle East representing 0.6% and the other category probably representing a smidge but not a measurable amount. If we take a look here at the markets, we can see that the largest represented market here is Japan at 21.5%. Then we have the UK at 13.3%, followed by Canada at 9.8%. And then you have France, Switzerland, Germany, etc., etc. So these are the individual developed markets that are included in the fund and where your money is spread out across. And once again, this is going to be a market value weighted index. So the larger a market is here in this case, the more weight it's going to carry in the overall portfolio. If we take a look here at the top holdings, we can see what companies are represented. A lot of these are names that we aren't familiar with, but some of them are ones that you've definitely heard of. For example, Nestle, Samsung Electronics, AstraZeneca, SAP, Toyota Motor Corp, for example. These are going to be making up a large portion of the portfolio. But notice here how this is not nearly as top heavy as VOO or VTI, for example, as the largest holding here is only representing 1.74% of the entire portfolio. So you're going to be more diversified across all of these different stocks because these particular companies are not so much larger than the rest of the others. Next on the list here, we have VUG, which is the Vanguard Growth ETF. This fund is going to provide you with exposure to large US growth stocks by tracking the CRSP US Large Cap Growth Index. Now, this index tracks the performance of 183 leading US companies with above average revenue growth. Now, something like VUG is going to be more aggressive than VTI or VOO, for example, because you are concentrated in growth stocks. That means during a bull market, when stocks are going up overall, you would typically expect something like this to outperform. However, during a bear market, when we're seeing a crash or correction take place, this is going to get hit harder than something like VOO or VTI, for example. As far as the expense ratio goes, this comes in at 0.04%, which is still extremely low, but slightly more than some of the others that we've covered already. And the dividend yield in this case is just 0.45%. It's going to be significantly lower because this fund is placing an emphasis on growth stocks. And a lot of these companies are reinvesting their profits versus paying out dividends, hence the lower overall yield. Just to show you an example of the outperformance here, the year-to-date return from this is 23.74%. We saw with VTI, for example, it was around 20%. So because this is concentrated in growth, it is going to outperform in a bull market. Taking a look here at the style box, this is in the top right quadrant because it is focused on growth and it is also focused on large-sized companies. As mentioned, there's about 183 companies included, and this is going to be the largest companies with above average revenue growth. So it is going to have a higher overall valuation in terms of what people are paying for exposure to earnings, but that's because those earnings are expected to grow a lot in the future. At least hopefully they do, so long as we continue in a strong overall economy. And you can actually see that over here looking at the PE ratio. So for this fund, it's trading at a 37.3x overall, and the price to book ratio is coming in at an 11x. So this is trading at a higher valuation compared to a value fund. That's again because of the future earnings potential expected from these companies. This is going to show us the overall sector exposure, and this is heavily concentrated into technology. 59.4% of the entire fund is in tech. The next largest component here is consumer discretionary at 16.6%, and that is going to be followed by industrials at 8.4%, healthcare at 7.4%, and so forth. The main thing you want to be aware of here is just how much of your money is going into tech, and that is because that is going to be most of the large growing companies in today's economy because of how tech focused everything has become. Again, if we scroll down, we can get holdings details, and you can see how concentrated this portfolio is. 13% of the entire fund goes right into Apple, followed by Microsoft at about 12%, and Nvidia here at just shy of 11%. So you're looking at about 36% of the entire fund. More than a third of all of the money invested just goes right into those top 3 big tech names, but you will notice some different company names listed here in the top 10. For example, Visa as well as Tesla, and that's because these are deemed growth stocks. And some of the other components of VOO or VTI, for example, although they are extremely large companies, they may not be considered to be growth stocks, so those are excluded from this fund. Now, the opposite of the fund that we just covered is going to be VTV, which is the Vanguard Value ETF. Instead of focusing on growing companies, this is instead focusing on well-established companies, many of which are dividend payers, and they are trading at a lower price to earnings and price to book ratio, for example, meaning that investors are paying less for their earnings potential, but that's because they're not expected to be growing their earnings like the growth stocks are, for example. VTV tracks the performance of the CRSP US Large Cap Value Index, and this index tracks the performance of 335 large company stocks that are deemed value investments. And again, Again, that means that the share price is trading at a reasonable level compared to the company's current earnings potential. As you can see, the expense ratio is 0.04%, but the dividend yield is the highest one that we've seen so far, coming in at 2.09%. Again, that's because of the emphasis here on value, and many of these value stocks are well-established dividend payers. If we scroll down here, we can see that the year-to-date performance here has been 18.9%, so it's on the lower side of what we've seen because of the emphasis here on value and income versus growth. Taking a look here at the style box, we're now in the top left quadrant. That's because the emphasis here is on large-sized companies that are deemed to be value investments. And you can see this here by looking at the PE ratio, which is coming in at a 20.9, which is a lot lower than the 37, give or take, that we saw with the growth fund. And the price to book ratio is coming in at 2.9x. So you're paying a much smaller multiple here on their earnings potential versus the growth portfolio overall that we just looked at. In terms of the total amount invested in this fund, that comes in at 183.2 billion. So once again, this is another very popular ETF. Taking a look here at the sectors, the largest component in this case is going to be financials, as 20.2% of the overall ETF. The next biggest category here is healthcare at 17.3%, followed by industrials at 15.6%, and then we have technology at 9.8%, consumer staples at 9.3%, and so forth. So there's a lot less money going into tech because a lot of those are not value stocks. A lot of those are growth stocks. Financials is where you're going to see a lot of value stocks, so that's why it carries so much weight in the overall index. Taking a look here at the largest holdings, the biggest component here is Broadcom at about 3.43%, just shy of 3.5%, followed by Berkshire Hathaway, JP Morgan Chase, United Health Group, ExxonMobil, Procter & Gamble, Johnson & Johnson, Home Depot, AbbVie, and Walmart. Most of those are dividend payers. They're companies that we've all heard of that have been around for a very long time, and so you are investing more of your money in well-established companies here versus those that are expected to be big growth names in the future. Next on the list here, we have our first bond fund, which is the Vanguard Total Bond Market ETF, trading under the symbol BND. This fund provides investors with diversified exposure to the investment-grade U.S. bond market, which is a blend of treasuries as well as corporate bonds. Bonds are designed to provide investors with consistent income, and the price fluctuations are going to be limited compared to equities, for example. As you get older, it becomes more and more important to diversify a portion of your portfolio into bonds to limit your downside potential with your overall portfolio. Now, a common approach that people follow here is called the rule of 120. That's where you take 120 and subtract your current age, and that is the percentage that you should have allocated into equities or stocks, with the rest going into bonds. So if you were 20 years old, for example, you might want to have 100% in equities and not necessarily worry about bonds yet. But by the time you hit 30, for example, that would be 90% equities, 10% bonds, and it's recommended to change that every 5 years. So at the 35-year mark, for example, you might want to do an 85% equities, 15% bond portfolio. Taking a look here at more details, the expense ratio is 0.03%, and the 30-day SEC yield for the dividend is coming in at 4%. So most of the returns here are going to be generated through the dividends instead of the underlying share price of the fund increasing over time. If we take a look here at the year-to-date performance, this is up 3.53%, so you are having some returns generated from the underlying share price going up, but as mentioned, most of your returns are going to be expected to be generated from the yields collected from the bonds, which is going to be paid out in the quarterly dividend payment. If we take a look here at the portfolio composition, this particular ETF has a total of 11,254 bonds, which is pretty crazy. The average maturity is 8.3 years with an average duration of 6 years. You can also see here that the total amount invested in this fund is an astounding $336 billion. Now, if we take a look here at the style box here, this is going to be different for bonds compared to equities, but this is sitting here in the top middle quadrant. So that means that you have a medium duration here on your bonds, and the longer the duration is, the more risk there's considered to be. So those are going to be slightly higher yields yields, that's sitting right in the middle, and the majority of your money is going into treasuries. So you're at the very top in terms of looking at the left-hand side in terms of the bond quality. Treasuries are going to be considered the lowest risk, and then you have the corporate bonds that sit below that, and within corporate bonds there's going to be credit ratings, which are going to show you what is considered to be investment grade bonds, and then you have junk bonds, and that's based on the credit worthiness of the individual companies. Taking a look here at the overall credit rating, you can see 68% of the fund goes into US government or treasuries. The next largest component is triple Bs, which is 13.2%, and then you have 12.3% in A-rated bonds, 3.5% in AAA, and 3% in AA. All of these here are going to be corporate bonds, and we can actually see some of those later on when we take a look at some other details. Looking here at the issuer type, you can see that the largest component here is treasury or agency bonds at 47.7%. Then it's going to be government mortgage-backed bonds, and then you have industrial, followed by finance, representing large components here of this bond fund. And if we look at the maturity window here, this shows us the average maturity for these bonds. So 1 to 5 years is going to be the largest category here at 44.4%, and then 5 to 10 years is the next largest group. If you want to know what particular bonds make up the largest components here, you can see that under the holding details. This is going to give you more information about them in terms of the percentage of the fund allocated there, maturity date, coupon rate, etc. But this is stuff that most people are not too interested in. And then you have the distributions. Now, one thing that's interesting about this fund is it has a monthly distribution schedule. So you'll actually receive a dividend for this every single month instead of on a quarterly basis. So that's one of the reasons why a lot of people like this particular bond ETF. Up next, we have another international equity fund, which is VXUS, the Vanguard Total International Stock ETF. This fund tracks the performance of the FTSE Global All Cap VXUS Index, and this provides investors with exposure to 98% of the entire investable market cap of the global stock market, excluding the United States. So this is going to be strictly international exposure. Now, how this differs from something like VEA, for example, the Emerging Markets Fund that we looked at earlier, is that this fund provides you with exposure to both developed and emerging global markets, whereas the previous fund was strictly developed markets. Emerging markets are areas that are transitioning from developing nations to a developed nation, and one example of that would be Brazil as a country which is an emerging market. So there is a little bit more risk in those markets, but there's also a greater return potential. So this is going to be capturing both emerging and developed markets, whereas prior that fund was strictly developed markets. There's also funds that are specific to emerging markets if you wanted to have a more aggressive international exposure. Taking a look at the expense ratio, that comes in at 0.08%, so it is a little bit higher than the funds that we looked at before, but not necessarily high compared to the overall industry average. And if you scroll down here, it actually will show you how that compares to the industry average. So that is coming in at 10% roughly of the industry average for similar funds, which is 0.88%. If we look here at the overall portfolio composition, we can see that this has a total of 8,667 individual holdings, and we can also see that the valuation trades lower here for international equities. That's one of the reasons why a lot of people like to diversify into international markets, is because you don't often see the same valuation as you do in the US equities market. The PE ratio is at 15.7 on average, and the price to book ratio is a 1.8x. In terms of the total invested here, the net assets for this fund at the end of August was $453.3 billion. So this is a very popular fund investment offered by Vanguard. If we take a look here at the overall exposure, we can see that 25.7% of this is in emerging markets, and then 40.4% is in Europe, 26.3% is the Pacific region, North America is 7.2%, Middle East is 0.4%, and then a very small amount going into the other regions, not a measurable amount. And if we take a look here at the largest markets, we can see here that Japan once again represents the largest portion, followed by the United Kingdom, and then we have Canada, China, India, France, and so forth in terms of the largest exposures for particular countries. Taking a look at the individual holdings, we can see the largest component of this portfolio is the Taiwan Semiconductor Manufacturing Company at 2.15%, and you'll also see a couple of other names that many will recognize. For example, we have Tencent, Nestle, Samsung Electronics, AstraZeneca, SAP, etc. So this fund would be good for someone who's looking for that international exposure, but they're looking to be a bit more aggressive than strictly investing in the developed markets. So this would be one that you may want to consider for your overall portfolio. The last specific ETF that we're going to cover here is VIG, the Vanguard Dividend Appreciation ETF. This fund tracks the performance of the S&P US Dividend Growers Index, and this index follows 338 US companies that have consistently grown their dividends for 10 consecutive years or more. This fund is good for those who are looking to derive income from their portfolio in the form of dividends, but are also still looking for modest growth potential. The overall expense ratio here comes in at 0.06%, and the 30-day yield is a 1.65% in terms of the dividend. Taking a look here at the style box, this is sitting here in the top middle, so it's going to be mostly large companies, but you're also getting a blend here of both value and growth, because this isn't necessarily the highest dividend payers. This is those who are consistently growing that dividend over a decade or longer. In terms of the total invested here, it's 100 billion. So again, this is a large ETF with quite a bit in assets under management. And the PE ratio comes in here at 25.3 and a 4.8 times price to book ratio. So it's going to be lower than that of like the growth funds, for example, but it is still trading at a higher multiple than international funds, for example, that we've looked at previously. In terms of the largest sectors represented, it's going to be information technology as the largest component at 23.3%, followed by financials at 20.1%. Then we have healthcare at 16.1%, and then industrials at 12.1%, consumer staples at 11.8%, and so forth. So you have a lot of money going into information technology, but not necessarily as much as we saw looking at some of those growth funds earlier. Taking a look here at the holding details, the largest component here is Apple at 4.57%. Then we have Broadcom, Microsoft, JP Morgan Chase, United Health, ExxonMobil, Visa, Procter & Gamble, Johnson & Johnson, MasterCard, etc. So some of the big tech names like Amazon, for example, are not listed here, and that's because those companies don't pay dividends. So you do still have a lot of concentration into some big tech names here, but it's specifically those who pay dividends and the ones that have grown that dividend every year for at least the last 10 years. That's going to wrap things up here for the individual ETFs that we're going to look at, but we only covered roughly 10% of what Vanguard has to offer. There's 86 individual ETFs through Vanguard, and we looked at 8 of them. So the next thing I want to show you here is the Vanguard ETFs list. You can visit this yourself if you want, and you don't even need to have a Vanguard account. And this can be helpful for screening purposes if you're looking to learn more about the different Vanguard ETFs. The first thing we're going to do here is click on Open Filters, and this is where you can sort this by strategies, for example, management style, asset class, etc. Looking at strategies, you can look at all-in-one total market ETFs or ESG if you're focused on environmental funds, for example. So for example, if we wanted to just look at total market ETFs, we could check that box, and that narrows us down to just 4. You can also look at the management style. So for example, if you wanted just passive style funds, that would be index funds versus active management. So we can check that box here of index, and that's going to be 78 of the funds total. Looking at the asset class, you can look at specifically stock funds, fixed income, as well as sector and specialty ones. So if we check on that box, for example, this shows many of the sector specific ETFs. So if you wanted to concentrate your money in one segment of the economy, they have all of these different funds. For example, communication services ETF, consumer discretionary, consumer staples, energy, financials, healthcare. This one's quite popular, VGT, the Vanguard Information Technology ETF, if you wanted to specifically invest in only technology versus having diversification across these other segments. Now, these are going to be more risky because you have less diversification, but this is something that, again, you might want to use as a garnish to your portfolio if you wanted to have more concentration into one particular segment. VNQ is another popular one, the the Vanguard Real Estate ETF if you want to invest in real estate. You can also take a look here at the risk scale and look at less or more risky investments overall and other things like that. Another thing here you might want to look at is tax efficiency. So there's all of these different screener tools here that you can use, which are helpful. You can also turn all of them off and look at all of the total list in entirety. And when you do that, you can click on something here like the SEC yield and see what are the top yielding funds, for example. In this case, it's going to be VWOB, the Vanguard Emerging Markets Government Bond ETF. So if you're looking for the highest yield, you can do things like that. You can also look at the expense ratio and see what's the highest, what's the lowest. You can also sort this by risk and look at the lowest risk to the highest risk. You can look at year-to-date returns and sort it like that, and all sorts of different things. So for example, the top yielding fund year to date is actually VPU, which is one of their sector specific ETFs, their utilities ETF. So you might want to play around with this just to see the other ETFs that Vanguard offers. You can also change this drop down up here to look at the index mutual funds and other products that they offer. Now I'm going to show you how to buy shares of any of these Vanguard ETFs mentioned using the popular commission-free stock trading app Robinhood. And here's the best part. You can get a free stock worth up to $200 when you open a new account using my affiliate link. First, you're going to visit ryanoscribner.com/Robinhood or click the top link down below and open a Robinhood account. From here, you just have to deposit any amount of money. Even $1 single is fine. After that, you'll get to choose your free fractional share from a list of 20 leading American companies. Now, I have a full 45-minute Robinhood tutorial for beginners that I'll put in the corner for later, but for now, let's dive into the quick investing tutorial. Here we are inside of my demo Robinhood account, and I already have $2 in buying power to invest with, but if you don't have any money in your account, all you have to do is click here on buying power and then click on the deposit funds button, and you can add funds from your linked bank account. Now, if you don't know how to link your bank account and complete steps like that, be sure to check out my full tutorial in the corner. But what we're going to do is invest in a fractional share here of VTI. So the first step is to click on the search icon in the top right, and then you can either type in the name of the ETF or the stock if you don't know the symbol, or the symbol. In this case, we know the symbol is VTI, or the Vanguard Total Stock Market ETF, and then we're going to click here on the top result. Now from this page, you can click here to see the performance of this fund over different periods of time. For example, over the last month, it's up just shy of 5%. Over the last 3 months, it's up about 3%. Year to date, it's up quite a bit here, almost 20%. Over the last year, a 32% return, almost 33%. The 5-year return here is about 88, and you can also look at other spans of time here if you want to. If you scroll down, you can get more information about the ETF as well as the total number of holdings. So in this case, it's 3,661 individual holdings, and you can also see here what are the major sectors represented as well as the top holdings in the particular ETF. Down below, you can see other key statistics here, including things like the 30-day dividend yield, which is currently 1.22%, and the expense ratio of 0.03%. And you can also get an idea here of what people also own in conjunction with this, in addition to the average annual return for the fund. So in recent years here, the stock market has actually had higher than average performance. Over the last 5 years, for example, the average return has been 15.18%. What we're going to do now is click on the green trade button at the bottom right, and then we're going to click on the buy button, and this will bring up the order ticket window. Now we're going to be by default investing in dollar value, but if you wanted to buy a whole share, you would just change that here in the top right, and one share, for example, would be about $281. But in this case, we want to invest in dollars, and we're going to put $1 into this VTI ETF just to show you how you can truly invest as little as $1. At this point, we're going to click on the review button, and this is going to buy us 0.00355 shares. When you're all set, all you have to do is swipe up, and just like that, we invested $1 single into VTI. If we click here on done and then return to the home page, we're going to see VTI listed under the stocks and ETFs that we own, and it's going to be listed here at the very bottom. So that's how easy it is to invest in these ETFs using Robinhood. Don't forget to use my link down below to get your free stock worth up to $200 when you sign up. But now we have to talk about the type of investment account that you use when investing in ETFs, because using a retirement account could potentially save you from a massive tax bill. If you invest using a taxable brokerage account, you'll most likely end up paying long-term capital gains tax rate on your capital gains, and that caps out at 20%. And in addition to that, there could also be additional state taxes that are owed as well, depending on where you live. Now, in the previous example of becoming a millionaire using the VOO ETF, we looked at investing $500 a month for 31 years and earning the average 10% return from the S&P 500. And here's the crazy part. Following that strategy, your account would grow in value, hypothetically, to about 1.09 million, but the amount of money that you invested would only be about $186,000. That means if you cashed out all at once, you would have about $905,000 in capital gains, and at a 20% tax rate, that would be a tax bill of about $181,000. But if you invest through a retirement account, specifically a Roth IRA, you can shelter yourself from all of these taxes on your capital gains, as well as any dividends that you earn along the way. Now, with a Roth IRA, you're going to be investing your post-tax dollars, and that means there isn't any upfront tax benefit like there is with a 401k, for example. Instead, all of the benefits happen at the end, so long as you don't touch the earnings in your Roth IRA account until the age of 59 and a half and follow a few other basic requirements. You will not end up paying any taxes on your capital gains or your dividends earned in the account. So if you're investing for the long haul, you should definitely consider using a Roth IRA retirement account. You can open one directly through Vanguard, and Robinhood also offers a competitive Roth IRA that you might want to look into as well. The last thing I want to show you are the steps involved with opening a Vanguard brokerage account if you wanted to invest in the ETFs right through Vanguard, or perhaps if you wanted to buy into the index mutual funds. If you click here on this button that says open an account, it's going to bring us to that page. Now, we're not going to go through the entire process, but I'm going to show you as much as possible. In a future video, I'm going to be doing a full tutorial on the Vanguard brokerage platform, so be sure to subscribe and hit the bell so you're notified when that comes out. At this point, you can choose whether or not you already have a Vanguard login or if you're completely new. So if you have a Vanguard 401k, for example, you can actually use that login, but if you don't, you're going to click on the sign up button here, and at this point, it's going to bring us through the setup wizard. The first question is, how can we get you started? You can choose between opening a new account with money from the bank, rolling over an existing 401k or employer plan, transferring investments from another firm to Vanguard, inheriting an account, or taking control of a UGMA, UTMA account if you have a minor account, for example. We're going to choose opening a new account with money from the bank, and then we're going to click on the continue button. Now from here, you can choose between having Vanguard help you with portfolio allocation through Vanguard Advice Services, or you can invest on your own. We're going to choose invest on my own. At this point, it's going to walk you through the steps involved and give you a timeline, which it says is about 5 to 10 minutes. You're going to choose your account type, provide personal information, and then add a bank account. So what we're going to do now is click on select your account, and this is going to show us the different types of accounts that they offer. So for example, if you want to invest in a retirement account, you can choose to open a retirement account and then decide if this is for yourself, for a minor, etc. So if you're opening it for yourself, you then have the option of opening up a Roth IRA, traditional IRA, or a SEP IRA if you're self-employed, for example. If we go back here and change this to a general investing account for an individual, you can then select the relevant account after you just choose yourself, and that's going to be an individual brokerage account. That's what we're going to move forward with, so we're going to click on the select button. At this point, it confirms that you're opening up an individual account, and it gives you details. So any earnings from dividends or capital gains may be taxable. You can withdraw at any time without penalties, no contribution limits, and you can invest in index mutual funds, ETFs, CDs, money market funds, stocks, and bonds through this account. We're going to click on continue in the top right. And at this point, you're going to fill in your name as well as your address, citizenship, social security number, gender, etc. So we're not going to put any information in here at this point, but those are the steps that you'd want to follow, and you'd be able to make a selection about if you're opening up a taxable account, retirement account, etc. So there is a wide array of offerings here through Vanguard. And just like that, you're now an expert on Vanguard Index Funds. Index fund investing is the only strategy that works for everyone, and now you can sit back and relax while other people might be worried about their stock picking strategies. And as you get older, it is important to diversify your portfolio outside of equities or stocks and invest in bonds as well, so be sure to talk to a financial advisor about that once you accumulate some substantial assets. If you made it to the very end, don't forget to drop a like on this video as well as subscribe and hit the bell for the YouTube algorithm. You can click below to watch my full video on Roth IRA investing, and I hope to see you there.